Hey guys, I am Amy Cornell and I am your Texas broker for Front Real Estate. And I wanted to talk today about different ways of financing properties and what to expect when you're representing a buyer that's coming to you with a variety of different options that they may be exploring as far as how they are planning on financing that property or home. So I wanted to start, I'm going to do a PowerPoint just so that way I don't forget to tell you anything. All right, so we've got that there. So the first way and the way that I love the most is cash. Cash is definitely king. It does give you the most competitive advantage in this market, in any market, y'all. Cash. It's wonderful. So what a buyer needs to understand about cash is that they are going to need to provide a proof of funds letter or a bank statement showing that they have that much money in the bank. I don't want to have any account numbers on there, but I do need to have their name to associate with the contract so that way we can prove that to the seller. So they need to go ahead and get that to us really before we ever start looking at houses, partly for your protection to make sure that that buyer does indeed have cash available. And then that way you can go on and as soon as they're ready to make an offer, you're ready to go. Keep in mind on cash that there are really no requirements. You could take a cashier's check in and pay somebody that they could sign a deed over and you're done. The property is sold. But if the buyer wants any specific due diligence period or information, so maybe they want to do an inspection, well, they should have a traditional option period then. Maybe they want to do an appraisal. Well, an appraisal would be ordered customarily by a lender. If they're not having a lender, then they can order an appraisal just on their own. Normally that is done concurrent during the option period with the inspection, but just make sure that you allow enough time on there to get that part done. You may also need to provide some resources as far as appraiser names and numbers that they can trust to call and start with. I will tell you, for me, most of my consumers do not go forward with an appraisal in this situation because I have provided a market analysis for them. And that's basically what an appraiser is going to do. They're going to look at the comps and then give a paper value on that house. So a lot of times they'll take my market analysis that's just provided rather than have to pay an extra fee for appraisal. Title policy is something that most buyers are going to want. It's just going to take about a week for the title company to get everything ready to close. So just know closing in about a week is customary if they want a title policy. And then survey, if they want a new survey too, normally that can be done in that week where they're preparing the title policy. Cash does not have to be hard, so don't make it harder than you need it to be. If you have any questions, definitely let us know and we're happy to walk you through it. All right, then different types of mortgages. So the most traditional mortgage that we see, I mean, y'all, we're seeing it probably 85%, 90% of the time right now is conventional. Conventional is, it's kind of how it sounds. It's a fairly standard conventional loan. There are some Freddie Mae and Fannie products with as low as 3% down. Most of the time they really start at 5% down and then go up from there. You can choose to put whatever you want to down on a conventional, and we see the gamut. If you're putting less than 20% down, then you are going to have mortgage insurance on the loan, but it is rated based on credit score and the amount of down payment that you put in. So if you have a pretty good credit score client that maybe is concerned because they aren't able to put a full 20% down, really have them run those numbers. The fees are relatively small on that kind of situation. It also might be something where they found the right house, but it needs a new shower or it needs new flooring. Well, maybe we take down that amount that they're putting down from 20% down into the 10 or 15% range, and just know that they're going to have mortgage insurance on it rather than trying to hire a contractor after and pay cash or do some sort of cash out or something on the equity that they're putting in from the very beginning. Hopefully that makes sense, but there are so many different ways to utilize conventional, and your lenders are going to be so good at really explaining the different processes with this. So really, because this is the most customary, it's going to be what your bread and butter is. You really get used to it. And if there's any questions, it's really easy to get answers on. Okay, FHA has, so over history, right? Things fall into favor and fall out of favor. right now, FHA is a little more out of favor. So the rates are very good. And sometimes when you look at a rate comparison with FHA and conventional, the FHA rate will actually be a little bit lower. But FHA has higher mortgage insurance and it is not as credit rated as the conventional side. So for FHA, really, you always put 3.5% down. There's just not a whole lot of benefit to putting down more than that. And then you'll have that upfront mortgage insurance of 1.75% down that's rolled into the loan. And then you also have monthly mortgage insurance for the whole 30 years of the loan. So most people are only keeping FHA for a little while and then they're refinancing into conventional, even if FHA is what they got from the very beginning. Just know that the appraisal requirements for FHA are a little scary for sellers. It really shouldn't be. It's not a huge deal, or we're not seeing it anyway in this market as being a huge deal. However, it's just gotten that reputation and it's difficult to get past that. So the big things for you to know representing buyers of what sellers are going to be feeling about it is that the appraisal sticks on the property for 120 days. Now it only sticks for if your FHA buyer bails and they have another FHA buyer that comes in. Doesn't happen all that often in this market, so that's not as huge a deal. What they're concerned about is that there are tighter appraisal requirements, and so there may be more lender required repairs on an FHA deal than on a conventional. Now, honestly, that is kind of an old wives' tale at this point. I don't have a lot of data to back that up, so I'm not going to say like, oh, I would automatically put an FHA to the bottom in a multiple offer situation. But keep in mind, I said so many deals are going conventional that it's kind of a red flag anytime it goes to FHA. And so that may be why it's getting kind of put to the bottom. It's just that the seller is just on edge of why are they going FHA. So it's just something to think about. The other thing with FHA is that there is a lockout period on a flip where FHA will not do a flip in a certain number of days. And honestly, I'm not going to quote the number of days here because it changes all the time. I believe that it is 120 days right now, but it's flipped between 90 and 180. So I'm not going to say 100%. Check with your lender and make sure if you're considering financing a flip with an FHA loan. All right. Let's see. So FHA and then VA. So VA is probably the top loan right now. If you can get VA, you're getting VA. It's just that it is only for our veterans that have served us. So we really appreciate all of their service. It's a great format of loan for any veterans, and it does offer a 0% down option. VA has their own set of appraisers, and so it does have a reputation with sellers as well as being a very stringent loan, and so sometimes it can get farther down in the stack of a multiple offer situation. But just know there's not really anything that you can do about it because it is a great platform for a lot of veterans to utilize. There is no mortgage insurance on VA, but there is what's called an upfront funding fee, and that is what's shown in this chart below. So if you have, like I've got a client right now that is moving here from Germany. They've been living on base in Germany. They had purchased a home in the past using VA, but they don't have that money that they made on that house available for down payment now. So they're looking at a 0%. It's their second and subsequent use. So that means they are going to have a 3.3% funding fee on that loan. So when they go in to do the loan, they're actually going to have 103.3% of the loan is what is going to be their mortgage. That's fine if they are going to stay put. It's not great if there's any chance of them calling me in 6 months and saying, hey, Amy, I got a great job in Kansas. Okay, I'm going to be devastated because the cost to actually sell the house for them is probably going to be around 8%. And so if I go in and they paid 103% or they have a loan for 103%, it's going to cost me 8% to get it sold. They're going to be potentially writing a check for at least 10% of the value of the house for me at closing. It's not a great situation. It has gotten a lot of our veterans into trouble. So I just want to warn veterans about that from the very beginning when they have that heavy funding fee, that they are as certain as possible that they are going to stay placed. What I love is when they will go ahead and pay that 5% or more. So then they're starting at, let's say, a 95% loan. They're only rolling in 1.5%. So they're starting at 96.5. That just makes me feel a lot more comfortable than 103.3. So all that to say, it's whatever they want to do, but just know that there is some danger in that. The other cool thing is if they have had any sort of active duty and they have a service-connected disability, if they have a 10% or more service-connected disability, VA completely waives the funding fee. I am seeing this very often with anyone who has had any sort of active duty service. So definitely ask, help make sure, that they know. It's a little awkward to ask somebody like, oh, are you disabled? Because a lot of times you can't tell. It's hearing thing or it's a PTSD. It's something not that's very visible. But it is something that can be a huge advantage for them, thousands and thousands and thousands of dollars of benefit if they do have that, and then they don't have to pay that funding fee going forward. All right. Texas Veterans Land Board, if you have any veterans that are interested in buying land in Texas, this is the way to go. So that's not a huge subset of the population, so I'm not going to spend a ton of time on it, but just do your research with Texas Veteran Land Board. There are some great opportunities out there for veterans to purchase land. USDA is a great option if you're doing anything rural. It does have a 0% down option as well, but it is income limited, so you can't do 0% if you're over a certain income threshold. This is only for rural properties, and out on their website, you can go in and put in the exact property address you're considering and see if it qualifies for it. Local banks. So sometimes local banks are the way to go, especially if we need some land covered, maybe a construction loan, maybe a consumer is doing a bulk investment purchase, or there's something unique about the situation. Don't forget about the banks as an option, because it is not, they have money, right? Not everything has to go the traditional mortgage route where it has to fit in this little box of what mortgage is. If you're getting those from other places, call and make some relationships with some local bankers, because there are some different opportunities there. Other ways of financing that I hear about from time to time. So first one is owner finance. We'll have consumers call and say, hey, I've heard that I can own or finance a property. That is true. So sometimes a owner may decide to own or finance for a buyer. Now, why would they decide to do that? Well, it's because they're not getting offers from anybody else who wants to buy their house. So it's not the best house on the block. It may be a little bit more of a dog house, but if it's the right house for that consumer, hey, great. Maybe it'll work. The other thing to keep in mind on owner finance is that they're likely going to want potentially a full price offer for whatever price they have set on the house. So it doesn't have to be bound by the appraisal guidelines or anything like that. There's really no rules on this. We're in the wild, wild west at this point. There's also no rules as far as interest rates, especially if they are just a one-off owner financer. So be prepared for a very expensive journey if this is what the buyer wants to do. But this is something where there would be a traditional closing and you would get paid traditionally on it. Lease purchase, not so much on that one. I will tell you, I really tell consumers it is a really dangerous thing to go forward with a lease purchase, and we just see them work out maybe 1% of the time. Maybe. So lease purchase is when a consumer is trying to find a property that they can lease now and buy later. Well, so when do they decide when do they decide what that property is worth? Now or later? Well, the buyer wants to decide what it's worth now. They want to contract at something that, hey, maybe it's worth $200 now and it's going to be worth $220 later, and I can buy it for that cheaper amount. Well, no seller's going to do that, right? They're going to instead want to contract for an outrageous price now that is really potentially not going to have realistic returns down the road. They're also going to want to see more than a regular lease payment on a property that probably is not worth it. So even though I get that it's uncomfortable to move, I get that you want to have those roots and have that comfort level and start building something, just know it is really unrealistic to think that that's going to happen on a lease purchase. And I really try to help people find any other way than going that direction. The other problem is too, from a realtor perspective, is how do we get paid on it? It really is just a lease with a very little chance of actually closing as a purchase. And so really you only get paid on a lease up front. And then in theory, you're supposed to get paid on a purchase down the road if that consumer buys it. We already know that's a fairly low chance of actually happening. And then how do you know if it closes and you just never know about it too? So it just is a tough one, and it's really not something that we would advise. I'd really rather see a consumer lease a property, hopefully for under what their house budget is, save the difference, and then be ready to actually purchase a home as soon as they can. Hard money is like an owner finance, but you can pick whatever house you want to. There are a lot of hard money sources out there. It's just a very dangerous way to go if somebody is purchasing for their main home on it. Where we see more hard money being used is more on the investment cycle. It's still somewhat dangerous, but if that's something that they want to do, they definitely can research and find those sources as well. Reverse mortgage. Reverse mortgage is legal in Texas only for about the last 5 years, maybe. And it is something that for consumers that are over a certain age, which I believe it's 62, I think both the homeowners have to be over 62, or maybe one has to be over a certain age. Y'all make a liar out of me. Again, it feels like these numbers change quite a bit. So you want to get with a specialist that specializes in reverse mortgage if you have a consumer that is considering it. Reverse mortgage would mean that, let's say that the house that I'm interested in is $300,000. I would go in and put down $200,000, but that other $100,000 would be a loan that increases over time rather than decreases because I'm not making payments on it. So I'm still going to be responsible for paying my taxes and insurance, but that $100,000, because I'm not making payments on it, would go up a little bit each month. So starts at 100, then it's 101, then it's 102, then it's 103, it's 130, it's 100, whatever it is, it grows over time. It can be a great option though for families that need to use cash for something else, maybe medical care or something like that, and need to still have mom and dad in a good spot. So there are some ways why that makes sense to use it. It's just hard. It's a tough one too. So just make sure that you're doing it responsibly and that you're helping those families as much as possible to improve their lives. All right, down payment assistance. I always tell the consumer, look, it's a little tough because you're raising one hand and saying, yes, sir, Mr. Lender, I can afford this house. I am a great candidate for this. You should give me a loan. But then you're also raising this other hand and saying, but I need some help because I really don't have enough money for the down payment and the closing costs. So can you give me some extra cash to make that happen? Right? It's kind of awkward. And so what I really, unfortunately, here's the situation. Down payment assistance just doesn't actually help very many people because it's a relatively thin margin of the population that actually fits in both of those camps. We see a lot of people that would qualify for down payment assistance, but their credit or their income is not sufficient to actually qualify for a home. We see other people that their income or credit is sufficient to qualify, but they make too much money to get assistance from down payment sources. So here's where I tell people, really your lender is your source. They're going to know about all the programs on this stuff. And so talk with them, say, hey, I want to make sure I'm not missing out on any first-time home buyer programs, any first responder programs, anything like that. Make sure that you're getting with them because they're going to know about all of them. There is really very little chance of us keeping up with all of the different platforms out there. And so utilize your lenders to make sure that they've got everything covered. All right, then the last one I have on here is I-10 loans. So those would be residents that are not U.S. citizens, but that are here legally and they are paying in taxes through their I-10 number. And depending on how long they've been here, and there's some other criteria, there are lenders that will loan them kind of like a conventional mortgage. It's not totally like it. And again, expect a higher interest rate, expect more that they're going to have to put down, some of those things. But it can be a great resource for those families that really want to be homeowners in the U.S. If you need a resource on those, I normally will just go out to one of the forums out there for Texas real estate and find somebody that's doing great I-10 loans, put it out on front agents. I know we have several that have clients that fall into this. I just always, I hesitate to give anybody now because it does change pretty often on who is serving these clients well. All right, so I hope that helps. This was There's a lot to know on financing and how to really serve clients well, but the more that you know, the more you get into it and figure it out, although it can be very frustrating, it can really help you serve your buyers really well going forward. So keep up the great work and let us know if we can help with anything. Thank you.